Welcome to today's webinar on our update on the LAS natural gas program and market activity that's going on right now. Just want to do some roundtable introductions on who you see on the screen. We have Fernanda Lazaro. She's LAS customer service rep. Probably a lot of you have dealt with her day to day with any kind of questions regarding the program. We've got Mike Nigro, Director of Gas Services Canada from our program partner, Edison Energy. I'm Eleanor Schneider, Program Manager at LAS. And today's webinar is going to cover basically an overview of what's been going on in the natural gas space the past few months, and I'm going to say in 2021, the changes in volatility that we've been seeing. Mike's going to walk you through the presentation today, just talk about it, from a high level, what that means for the program participants, and how the program's being structured to help get the program participants through this market. And then some of the things that you'll be seeing in 2022 and, how things are structured moving forward. I'll hand it over to Mike.
Thanks, Eleanor. To give everybody a kind of a quick overview, like Eleanor had mentioned here, we're going to use today's space to go over what's been kind of going on in the natural gas markets as of late, kind of where we've been, where we are, and where we're going. Just to give you, it's been a little bit of a bumpy ride, to say the least, over the past several months. So hopefully we'll give a little bit more guidance, a little bit more insight to program members as to what they can expect heading into 2022 as part of the LAS natural gas program. I'm sure a lot of you have already seen this slide in previous webinars, but this is basically to just give you a high-level overview of the program statistics themselves, and the overarching goals of what the LAS natural gas program tries to achieve through its natural gas purchasing. As we've mentioned in previous meetings, the LAS natural gas program does follow a 4-year natural gas purchasing horizon, where we do purchase the gas requirements in various levels, various hedge increments, ultimately working up to a total fixed percentage of around 80 to 90% of the program's natural gas requirements, with about roughly 10 to 20% exposed to spot market conditions. But through this layered approach, we try to take advantage of opportune purchasing times during the year as we see fit. Try to work down the weighted average of the natural gas program price, as well as try to mainly achieve stability, budgetability, and reducing volatility going into new contract years. And as you'll see, as we get through this presentation, you'll see again kind of solidifying why we're taking this approach to purchasing natural gas for program members. So jumping right into it itself, as far as the natural gas markets go over the past, I'd say, year and a half, really with the onset of the pandemic, the natural gas market can be summed up in one word: ugly. It's been very ugly, to say the least, and that's probably even an understatement itself. But really, natural gas prices over the past year and a half have just continued to gain momentum and continue to move up in a significant way. And really, ultimately, over the past several months, it's boiled down to two items: storage and production. Natural gas inventories coming out of last winter were at relatively low levels, even though we had overall a milder winter last winter. At the end of last winter, we did see the onset of some significant colder temperatures, especially in mid to end of February. Majority of North America, especially the southern U.S. and Texas, just got rocked by some significant colder temperatures, which caused a significant spike in the market. As well, too, on top of that, we saw extended colder conditions through the months of April and May, where typically we don't see a lot of heating demand. It's typically regarded as a shoulder season, a recovery season for after the winter to get some decent storage injections under our belt before summer power generation demand kicks in. But basically, we saw almost within a blink of an eye a quick transition this year between winter and summer. So no real spring transition, which didn't help us kind of have a good rebuild during the spring to get some gas back into the storage. We did see some hotter than normal conditions during the summer, some increased power generation demand. And that's ultimately been leading to where we're at today now on the cusp of winter. You can see there that both US and Canadian natural gas inventories are anywhere between 80 to 90% full heading into this winter. But the key takeaway here is we are behind historical levels. In the US, we're about 400 BCF behind last year's level. Canadian natural gas inventories are roughly about 100 BCF behind last year's level. And that's what's been leading to ultimately to concern heading into this winter, that given this current storage deficit, what will happen? What will happen if we see relatively normal to colder than normal conditions going into this winter? How will this deficit stack up? The other side of the equation, or the other side of the coin, is natural gas production. Over the past several years, we have seen some significant growth in natural gas production, primarily south of the border in the US. Given the activities of last year, 2020, and the global oil market collapse that we really saw a decline in associated gas production and really no interest, especially in the US, on any additional investment, at least in the short term, of expanding drilling capability for the time being. So we've seen relatively flat production over the past year or so. And heading into 2022, at least in the short term through this winter, we aren't expecting any significant growth in natural gas production. We are expecting to see maybe some recovery mid to late 2022. But again, with the market kind of having this tunnel vision right now and focus obviously being on the winter months, the combination of storage deficit and no growth in production and the wild card of winter weather has just really led to a bullish uptick in natural gas prices. That really right now the only thing that the bearish side of the market is grasping on is hoping for milder conditions going into this winter. But we'll touch on that as well too as the presentation goes on. Again, production numbers relatively flat both in Canada and the US. We are expecting here in Canada some slight production growth going into 2022, a little bit of a different mindset from the Canadian production side of things. Producers looking to take advantage of higher prices in the Canadian markets, as well as take advantage of lower production numbers in the US, specifically the US Midwest. So we've seen a significant uptick in Canadian natural gas exports to the US year over year of about 15%. So again, that leading to some of the upward price pressure right now as more gas being shipped to the US rather than looking to refill local inventories right now. So a little bit of a different dynamic between Canadian and US production right now, but overall, a bit of a flat production outlook, at least in the short term, which again is leading to concerns of more upward pressure of the market the deeper we get into the winter. So the first line of this next slide basically just again sums up what we touched on. We've been in an extremely bullish market. Just the market continues to move up. The windows of decline that we have seen throughout the year have been extremely tight, very small. We talk about in the natural gas markets that the market moves every 15 minutes. In a relatively quote unquote normal year, movement every 15 minutes equates to somewhere between 2, 3, 4 cents Whereas, we've been more accustomed to over the past several months, movements of anywhere between 20 to 30 cents in a given day, and sometimes even higher than that. So significant movements in the daily markets and the future markets, making it a lot harder for customers to hedge in the forward market, or narrow down, I guess, what a good value hedge is given the upward movement. The other key takeaway from the slide here, and what's been also really contributing to the significant upward movement we've seen over the past few months here, has been what's been going on globally in the natural gas markets. I'm sure many of you have maybe seen in the news concerns right now, significant concerns right now growing in the European and Asian markets in regards to natural gas supply going into this winter. Anticipating some extreme shortages going into this winter. And really what that has done is it's done two things. One, locally in Europe and Asia, it's pushed the price of natural gas in those markets up to anywhere around $35 to $40 US per MMBTU. To put that in comparison, locally in North America, we're trading anywhere between $5 and $6 US per MMBTU. So a significant spread nonetheless, compared to local markets to overseas. What that's also done is ramped up the value of liquefied natural gas and the associated demand in the US to move gas overseas. So again, perfect storm scenario right now. Flat production, low inventories, and we're seeing about 15% of the US production right now is actually being moved overseas. Producers, again, not really concerned about local inventories. It's ultimately dollars and cents that decide where gas goes. And with flat production and low inventories, prices have still gone upwards as gas moves anywhere else but locally in North America. So this has contributed to some of the significant upward push that we've seen over the past several months. Now, going into this winter, a question that's come up a lot, and I mean really comes up every winter, is what type of a winter could we expect to see? Right now, the National Oceanic and Atmospheric Administration in the US released their recent winter outlook for this year. A lot of people are anticipating potential La Nina conditions, similar to what we experienced last winter. So what that means is potential milder winter conditions overall, maybe a little bit more precipitation, but overall milder conditions in the eastern part of North America and Canada, specifically in Ontario and Quebec, looking at potential above normal conditions, maybe some colder conditions in Western Canada. But overall throughout North America, anticipating slightly milder than normal conditions. But again, when it comes to weather, take it with a grain of salt. As we saw last winter, we saw relatively milder conditions through November, December, and into January. And then November basically came out of nowhere with very frigid conditions, which caused the market to spike to significant levels that we hadn't seen in several years. So like we tell most customers, don't put all your chips into winter weather because it can change on a dime. But a key takeaways here looking ahead, again, extremely bullish market. The risks in the market include weather, storage deficit, no growth in production. In summer months, we're seeing still more coal to gas switching for power generation. So volatility isn't necessarily limited to just the winter, as we are seeing more demand during the summer months as well too, depending on how hot it gets. As well, with things returning to relatively normal in the economy post-pandemic, we are starting to see relatively normal demand again as we're getting out of these lockdown scenarios. And like I touched upon on the last slide, seeing increased natural gas exports to the US and increasing LNG demand. The other side of the LNG demand too, which we've maybe touched upon in previous webinars or previous bulletins that have gone out to members, is the development of Canadian LNG. So we are still several years away from the Western Canadian markets getting involved in the liquefied natural gas markets. but that's still on the horizon and still can add some upward pressure as we see increased demand on the LNG front as well. So the key takeaway, the key message to members is anticipation of, at least in the short term, increased natural gas costs going into 2022. Not much time spent on this slide here. This just kind of gives you an indication as to how Canadian natural gas inventories are shaping up going into this winter. The graph on the right there is a little bit busy, but just kind of shows you the injection and withdrawal status year over year. The main takeaway from this slide would be the graph on the left there showing both inventory levels for current as well as compared to last year for both Western Canada and Eastern Canada and Ontario at dawn. You can see the bottom two lines there being Eastern Canadian natural gas inventories at dawn, and you can see we're pretty much in line with last year's levels. However, Western Canadian inventory is a little bit of a different story, as you can see that significant differential compared to last year. So obviously not helping our cause going into this winter from a pricing perspective. As far as production actually goes, this graph here outlines the Canadian oil and gas rig count. Main takeaways in this is you can see a significant recovery that we've seen in response to recovering oil and gas prices in the markets. Right now, Canadian oil and gas rigs are currently at about 164, which represents about a year-over-year increase of 78 compared to last year. So again, pricing primarily driving the recovery in oil and gas production right now. We are at about, say, 65% of the rigs deployed in early 2020 before the pandemic. So again, we are still below where we were pre-pandemic, but are starting to see that recovery primarily in response to the higher prices that we're seeing in the market right now. So this slide kind of gives us a trip down memory lane as to what's been happening over the past several years as far as the natural gas markets go. What kind of sticks out as a sore thumb here, you can see the winter of 2013, 2014, everybody's favorite two words, the polar vortex, where we saw, relatively complacent market conditions leading up to that winter. We saw several years of relatively flat to low prices in the markets, and then saw a winter of sustained extreme cold temperatures, which sent the market to new heights. Our saving grace coming out of that winter at 11-year low for storage, was really Mother Nature. Things could have been very ugly coming out of that winter as far as the recovery of storage goes. But really Mother Nature was on our side for really 2 years after the polar vortex, where we saw a cooler summer, some back-to-back winters of milder conditions. So not a lot of demand really 2 years after the polar vortex, which gave the market some good time to recover and kept prices relatively low. Also during that time period, we saw significant increases in US natural gas production as efficiencies for natural gas production and drilling improved, and more gas coming in the ground and hitting new records. And then fast forward to where we're at kind of today. We touched a bit upon the cold end to last winter, and we can see towards the end of that graph spiking in the prices around the end of February there, a little bit of recovery going into March and the start of spring, but then with some colder temperatures into April and May and concerns about how natural gas storage was going to recover over the summer months and flat production, natural gas prices have had nowhere to go but up as we basically round out 2021 and head into 2022. As far as the forward market prices go, so these two graphs basically show how the forward markets have been trading over the past several years for the gas years starting November 21, 22, and 23. The graph on the left there being natural gas prices at AECO, which is the main trading hub in the West in Alberta. The graph on the right being landed natural gas prices at dawn in Ontario. Again, the main takeaway here that you can see is just the steady increase in forward natural gas prices to hedge. You can see trending in the mid $4 range right now. So what that means is, to put this in perspective, if you were to look at the let's say for the graph on the right for landed gas prices at dawn in Ontario, if you wanted at say the end of October to purchase the forward strip November 21 to October 22, you'd be looking at a price of approximately $5.71 Canadian per gigajoule. So a significant increase nonetheless from where we were earlier in the year when prices were trading at about in the low $3 range. The other takeaway from these graphs here that you can see is we're actually seeing backwardation in the market right now. So what that means is the further you go out when looking at forward hedging opportunities, so looking at the November 22 and November 23 gas years, those are actually trading lower year over year. So what that is essentially signaling is potentially we will see some market recovery as we go on further down the line. A lot will obviously hinge on what happens this winter and what natural gas inventories look like coming out of this winter and into the spring. But the market is anticipating that, again, we should see production start to recover mid-2022 and should start to refill storage again. But again, forward market can quickly change on us if we start to see colder than normal conditions and really start to see a depletion of natural gas inventories the deeper that we get into the winter. But right now there are opportunities for year over year reductions in comparison to 2022. So obviously, big question right now is, how is the LAS program shaping up against the forward market? And this graph kind of sums it up. The blue line represents what the forward market is currently trading at. So if there wasn't a hedge in place, this is how the forward market is currently trading. The orange line represents the LAS program price going forward. So based on the hedges that we have completed, as well as the estimated portion of what's exposed to spot market. And as you can see here, relatively flat line for the LAS program over the next 4 years based on the hedges that we have in place. And as well too, opportunity for potential savings against the spot market, especially when you're looking at short term going into 2022 and the upward pressure that we're seeing on the short term markets right now. Obviously, this comes with a disclaimer that market is constantly changing, so this isn't necessarily a guarantee of what the market will look like over the next 4 years, but just gives you an indication of how LAS is positioned relative to the market right now. The main takeaway here is that we still do have a lot of flexibility in the outer years as well too, to continue to add in hedge layers as we go and as we start to see some market recovery. So ultimate goal of the program is to continue to keep prices stable, as well as look for opportunities to bring down that weighted average price in the future years as well. So some key takeaways. This is kind of will bring us to the end of the presentation here, but just some key takeaways that we want to give to members is, for this last contract year that just ended October 31st, 2021, the commodity price for the program was set at 10.1 cents per cubic meter. To put that in perspective as to how the spot market behaved over that same contract year. So if there wasn't a hedge in place, market prices averaged about 12 cents per cubic meter in comparison. So you're talking roughly about a 2 cent per cubic meter differential that the program price was lower than spot market, lower than spot market prices. So not only did we have that protection this year, but we also came out on the winning end of the equation when looking at how the spot market and the associated volatility that we saw through majority of 2021. Now, looking forward, a lot of the members have received the bulletin from Eleanor and the team at LAS regarding the new program price, which will be set at 11.7 cents per cubic meter for November 21 to October 22. So key takeaway obviously is we are seeing an increase in the year over year commodity rate for members. This was obviously a given current market condition, but given the hedges that we had previously in place from previous year strategies that we had executed, we were able to still keep that member price significantly lower than current market conditions. So roughly about, say, 6.5 cents per cubic meter lower than where the current forward market is trading. So a lot of wiggle room right now to stay below forward market conditions. As well as, again, have that stability going into this current winter of uncertainty. Another key takeaway here is that local utilities will not be immune to these upward movements either. They change their rates on a quarterly basis and are a reflection of what the spot market activity is. Local utilities cannot take a forward position in the markets, and their prices are a reflection of what they're buying in the daily markets as well too. So as we get into the winter, the expectation is utility prices will be adjusting their prices upward to follow that of the market. So ultimately, I mean, again, even though we are seeing upward movement in the market, even though, what we've covered, all the bad news stories that we've covered kind of through this market update, I think the key takeaway here is, members shouldn't have any sleepless nights going into this winter. We will have great protection going into this winter. We do have a lot of wiggle room going into this winter as well too. And going forward, we have lots of flexibility still to take advantage of when the market finally recovers going into 2022. And our job through Edison Energy and through our partnership with LAS will be, once we get out of this winter, we'll be hit the ground running, start to prepare strategies and look for ways to continue to add layers to the program and continue to keep relatively stable pricing and looking for year over year cost reductions as well. So with that, I will pass it back over to Eleanor Fernanda to see if there's any questions there, and we can address those.
Thanks, Mike. Great presentation, and thanks for that overview. I do see Q&A coming in through the function, and I'm going to pass it over to Fernanda, and then we can just kind of do a wrap up at the end once we address the questions. Fern, do you want to just read out the questions?
Yes, I'll read. And thanks, Mike. Okay, so first question: what happened to global warming?
I think we could probably have a whole separate webinar on views on climate change and whatnot. But I mean, I think it's evident over some of the weather patterns that we've seen over the past several years that definitely something is different in the climate these days. Again, it's making it a lot harder for us as consultants, for anybody in the natural gas industry, to just completely bank on a colder winter. Like that's what makes these strategies, or adds an added layer of trickiness, I guess, to coming up with strategies, is having to anticipate that not every winter is going to be cold, not every winter is going to be like the last. Again, example of that would be the polar vortex, where we saw one end of the extreme of a significant cold spell, and that impacts of the markets. The other side of the equation, seeing the winters that followed after that, where we saw relatively milder conditions, and even up to last year as well too, this past winter, where we saw a significant milder start to the winter. And then, I mean, well, you can ask the people down in Texas about climate change and how it impacted them during the month of February several months ago there, as they're still dealing with the financial impacts of what happened to that market. So global warming, climate change, I mean, it's evident that it's out there. The government, obviously, regarding what we've talked about in webinars and bulletins, and the federal approach to carbon tax and output-based pricing system and trying to manage greenhouse gas emissions. The belief is that climate change is happening and having a significant impact on our markets nonetheless. So,
thank you, Mike. All right. Next is to do with carbon tax. I had a question as well, so I'll just answer off the Q&A. Does carbon tax affect natural gas prices? And then I had an additional, how does that impact the program?
Okay, so so two answers to that. Yes, carbon tax does impact natural gas prices. So each member, and I believe we've had separate webinars, separate bulletins that have gone out about this, but the carbon tax does appear as a separate line item on your end use utility invoice. So you are paying a per cubic meter on the gas that you're using is the carbon tax. Now, the second part of that equation is no, it is not controlled through the program. The program is only looking at the purchase of the actual molecule itself and the deregulated transportation to move that gas into Ontario, to move that gas into the franchise area. So we have no control over the carbon tax. Carbon tax is basically, you're paying that regardless of whether you're buying your gas through the program or through the regulated utility. And like we've touched upon in previous communications, and as well too, given the results of September's federal election, the carbon tax is here to stay. At least, again, at least until our next federal election, carbon tax is here to stay, and it's only anticipated to continue to go up. So members can expect to see another increase come April 1st of 2022, as it goes from roughly 7.8 cents per cubic meter to, I believe, 9.8 cents per cubic meter. So a significant increase. And then year over year, it continues to get worse. But the wild card continues to be between now and the ultimate goal of the Liberal federal government of hitting their greenhouse gas emission targets, reduction targets by 2030, is that we most likely will see another couple of federal elections along the way. So we'll continue to keep members advised of cost impacts, so that way they can budget accordingly.
Would love to receive monthly or quarterly reports comparing market rate cost versus LAS rate costs for all of our accounts. Any update on that report request? So I guess those are remember how we used to get the quarterly reports, or even monthly? I don't recall if we ever got monthly reports, but we did get the quarterly reports at one point.
I think this would be more of a takeaway for myself, Eleanor, and Fernanda to discuss, and maybe have some further discussions with members as to what they see. I know through this year we have been providing members with some performance reports, and I don't think it would be a problem for us to keep those updated. I think this would be more on an individual requested basis that maybe again, we have no problem providing that information and have access to that information. So if there is something that a specific municipality would like to see on a regular basis, we could probably work that into a schedule. We do have the quarterly bulletins that do go out regularly, where we try to give a high level view of how the LAS program is performing against the market. But if there are some more specifics that municipalities would like to know about their involvement in the program, I don't think it would be a problem, but maybe we could use that as a takeaway. I'll leave it to Eleanor, Fernanda. I'm not sure if you have any additional comments on that, but
I'm going to say we'll take it as a takeaway and look at how we can accommodate this to do it probably on a quarterly basis. I think that might make a little more sense, as opposed to doing it monthly and just looking at capacity and how we can coordinate that between LAS and Edison.
Right.
So definitely something to provide to our program participants.
Okay.
And lastly, for the Q&A, I have my own questions here. Does LAS provide an option for green or renewable natural gas?
So for the time being, for right now at the moment, right now, the traditional LAS natural gas program only looks at conventional supply, conventional natural gas supply. We don't offer right now a green or renewable option. And that's mainly a result of the market right now. Right now, while it is starting to see an uptick, there is obviously a lot of interest and a lot of development going on, especially on the local utility level. It is the green natural gas, renewable natural gas, landfill natural gas, whatever you want to call it, is still relatively in its infancy and is not necessarily a commonly traded product right now. Some suppliers are getting into the mix of it and starting to offer it. But I would say the one kind of caveat is it isn't necessarily a one for one. It's not necessarily like one GJ, you're not necessarily going to get the same quality or content of one unit of green natural gas for that of conventional natural gas. So it is something that we are as a consultant, is obviously making up a big part of our business right now. That there are questions, especially with carbon tax, and not only from a federal government perspective, but also an individual customer's perspective as they look to reduce their carbon footprint and look at means of getting into the renewables markets. It is something that we are taking a look at, but it is still something that is relatively in its infancy. But I would imagine that it's not necessarily something that I can either stamp a timeline on either, but I would say over the next several years, we could probably see a ramp up in that, and could be part of the LAS program down the line, where we do offer a component of it that is renewable. But I see renewable natural gas options as being more complementary to conventional supply, not necessarily replacing it altogether.
And I'm just going to add a point that LAS is doing some research. We do have a project underway exploring renewable natural gas, and again, what that means for the future. So it again, as Mike said, it's not part of our day-to-day program, but we are doing research on our end in terms of what that looks like in the future, and how we can incorporate that into our program offerings, if it makes sense.
Thank you. And now some questions I get, regular questions from municipalities, and you did touch on, Mike, on the hedge, and that we're still quite good compared to the current market. But I do still get asked a lot about savings. So can a municipality save? And I know the program isn't about saving, but I do get that question quite often.
Yeah, I mean, it's a dangerous word to use, obviously, savings in these markets. And I mean, this isn't just applicable to the LAS program, but this is applicable to any customer that we deal with that purchases their gas third-party supply. We approach this mainly from a hedging perspective. We approach this from a stability, price certainty, budgetability, and to an extent, looking for year-over-year cost reduction opportunities. That's the way that we approach this. I can say that, going into 2022, and especially, the year that we've had in the market and the significant uptick, I'm not going to guarantee it, but I can say that it is looking like members will see a savings versus essentially going into 2022 fully exposed, just given the upward pressure that we've seen on the market, given the fact of all the bullish fundamentals that we're seeing in the market right now, and just looking at the LAS program price and the fact that the LAS program price is going to remain stable regardless. So between what happens now and what happens between now and March, what happens this winter, that 11.7 cents that members are seeing on their natural gas bill as part of the program will not change. I can say that that's a fact. That will not change. Again, all indications right now are that there will be savings against current market conditions, although again, prices are subject to change as we get deeper into the winter and what actually comes to fruition. Same on the utility side, because I know that's another common question is, how do we stack up against a regulated utility? And I touched on this a bit, the regulated utility is not going to be immune to these increases either. And we've started to see that with some of the quarterly adjustments that came into place for October 1st, October 1st of this year. Again, utilities cannot take a position in the forward market. So they're basically flowing through what they're buying gas at the day market. So as the market increases, their rates will increase as well. So I would anticipate that members could see anywhere between 2.5 to, best case scenario, 4.5 cents savings against market, and assuming the regulated utility follows the market, the same pattern as the market, you'd see a relatively similar savings against a regulated utility. But again, price is subject to change on the market side, not on the LAS program side, though. That will stay intact.
Thank you. And you've mentioned it, but I'll ask it anyway. What are the advantages to a hedge as opposed to the utility prices?
I mean, the main thing is stability. Price certainty is the biggest takeaway right there. Again, utility is totally exposed to spot market conditions and the fluctuations that we see in the market. And at the same time too, it's not like you can call up Enbridge, if you start seeing your natural gas bill going up, it's not like you can call up Enbridge and say, I want the pain to stop and I need to enter into a hedge. Most likely they would direct you to either, a consultant or a third-party purchasing program like that of LAS, that the utilities do not have the ability to enter into a hedge themselves, nor enter into a hedge on behalf of a specific customer. So the main takeaway is cost control. That's the biggest benefit. We have cost control and flexibility to take advantage of opportune times in the market.
Perfect. And last question, there are no questions in the Q&A box. So transportation, I know with the hedge, we're able to hedge the unregulated portion of transportation, correct?
Yes, that's correct.
Now, this is actually, it's even not a question that I had rehearsed with you, but this sort of came to mind is, are there certain utilities, like the unregulated portion, do certain utilities have a choice as to which transportation they're unregulating?
No, so basically through the program, we control two cost elements. So the cost of the commodity itself, so the actual physical molecule of gas, as well as the deregulated transportation. So that's the essentially the cost of the third-party supplier to move that gas into Ontario, to essentially move that gas to the main storage hub, Dawn. So those two components we have control over through the program. The other components of regulated transportation, regulated distribution, we don't have control over. That's essentially the cost of the utility to move the gas the rest of the way. So to move the gas from Southern Ontario, so Dawn is essentially the storage hub, is located just outside of Sarnia. So the regulated component, the regulated transportation, is to move that gas further into the franchise area. So basically to move that gas from Sarnia into the GTA, or move that gas from Sarnia into Northern Ontario. And then as well on top of that, you have the regulated distribution to move that gas straight to the meter. So those elements we don't have control over. It's mainly buying the actual gas and moving it into Ontario.
Thank you.
No problem.
I have no more questions.
Okay, perfect. So thanks, Vern. Thanks for going through that with us. And just want to wrap everything up then quickly. Thanks to all our participants today. Just a reminder that, we did record it. We will be sharing the video with you. We are going to have a quick little survey at the end of it. So hopefully, you have a few minutes just to fill that in for us, just to give us some feedback in terms of, how we met your expectations, or if you want anything else to be added in the future. A couple of things, just high points that I also want to mention that I didn't at the beginning. We're preparing our natural gas rebate for our program participants participants. So expect that in the mail. That will be going out by the end of the month at the latest. I believe the checks will be ready next week. So keep an eye out for that. The additional thing on the carbon tax, just we touched on it here, talking about, the increases that are coming, it's not going away. We are planning to have a short webinar on that in March, just to remind our program participants, what's happening April 1st and, just a quick, very focused webinar on that. And then, just a reminder that, the program is structured for the long-term view and typically for stability. So, we're at a point, and positioned in such a way that program participants are really going to see the benefits of being in this program. But, at the end of the day, it really is just to keep things stable across your budget line. With the activity that's going on in the market today, definitely you are going to see some benefits for being in that program, but always remember these programs are really structured for the long-term view, and that's what the hedge is there, and built in to protect you from that volatility in the market. So again, I want to thank Mike for going through the presentation today. Did a great job. Thanks, Fernanda, for moderating everything, and thanks to all of you for joining today, and have a great rest of the day.